Over the last couple of years, a key group of companies known as the Magnificent Seven has emerged. This group of high-performing and influential companies includes Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. These companies are at the forefront of sectors like artificial intelligence, electric vehicles, cloud computing, and digital services. They have also been positively impacting much of the growth in the US stock market recently. Just last year in 2023, these 7 companies' stocks grew 73%, while the rest of the S&P 500 grew 8%. These companies are routinely showing up in many of the financial headlines, and it got me wondering, is the US stock market too reliant on a few large companies? So I reached out to my friend and fellow CPA Erik Baskin to see what he thought. And of course, he had a ton to say about this. So as any podcaster would, I asked if he'd be up to record a conversation about it. In this episode, Erik shares his thoughts about the Magnificent Seven's impact on the stock market. We discuss if this concentration is new. We also explore what changes, if any, you should make to your investments because of this. Erik and I also had this awesome conversation near the end of the episode about when being a super saver doesn't make sense anymore. It really had me thinking about a few things in my life currently. So let's get into it. I hope you enjoy my conversation with the airman turned financial advisor, Erik Baskin. You know those moments where you think, I wish I would have learned this in school? Those are the topics that we love to talk about. Join me each week as I interview experts sharing their strategies for solving problems that us young adults will face throughout our 20s and 30s. So what are you waiting for? If you want new episodes about adulting advice every Monday, hit that follow button. Well, Erik, excited to have you on the show. This has been a long time coming. I tried to pitch you last fall, and for some reason, we just never landed on a topic. But this topic for today's conversation has me really interested, mostly from a personal reason, because I'm finally starting to build the portfolio up enough that I have to start thinking about diversification and even some of the long-term planning. Over the last 5+ years, I've been in such a grind mode of just growing and really growing income and growing my savings rates and all of that. But now it's like, wow, my investment portfolio is like doing some of the work for me now. Like it's not just like the growth that's happening is really from my own hard labor. But I've been starting to see or read some things around diversification, specifically with the US stock market and how reliant we may be in the US here on a few key companies. Magnificent Seven comes out a lot. You know, that's the Apple, the Alphabet, the Amazons, the Meta, Microsoft, Teslas of the world, these big kind of juggernauts, especially in the tech space. I want to start the conversation there. I'm really curious because I actually got a little fascinated. I invested in an index fund through Fidelity called FC Rocks, as a lot of people like to call it. And it's really just a total US market index. I did the calculation, and actually the top 10 make up 30% of that index fund. And that index fund is 2,600 companies. I want to throw it to you. Is that an issue? Like, have we become too reliant on a couple of key companies? And do we need to think about maybe diversifying our portfolio out of some of these total market index funds because of that?
You know what? I think broadly, generally, is that an issue for like the US stock market? Certainly no. I don't think it's anything that's new. Back in the 50s, you had auto companies. You had a lot of manufacturing companies and just in the 1900s in general that were kind of owning the stock market indices. And now we've got tech and now we've got AI. So it's always going to be something new. I don't see philosophically any real big problem with it. For the investor, it comes down to a little bit of what you believe in. Do you want to potentially just own more of these top 7 companies? If we look back in history, Amazon was in a garage 25 years ago. These companies were not the top companies 25 years ago. So I think as an investor, you just have to think, hey, do I want to be overweight into these and maybe like only invest in these individual securities or maybe an S&P market cap index? Justin, you said you have a total stock market index. And if that's true, that is much more diversified than just a straight up S&P 500 index, right? Because that total stock market index, as you said, has 2,600 stocks in it. Whereas an S&P 500 is going to be just those 500 and heavily weighted towards those top 7, the Magnificent Seven, as you said. So I think to answer your question, not really an issue, nothing new. For the investor, I think you do have to be aware of where you're investing and what your portfolio really looks like. I would encourage investors to go to Morningstar has it. I think Fidelity actually has it now through Morningstar. Google like portfolio X-ray. Fidelity, I'll try to get Justin that link. You can put it in the show notes, but you can put in your holdings of your portfolio and it can show you exactly, it's called a style box of your holdings. So it's think of like a 3x3 square tiles, and it'll tell you left to right would be like value to growth. So the left side's value, the right side's growth. Bottom to top is small to large. So these companies, it'll do an analysis of everything you own. It'll say, hey, this percentage of your portfolio is large cap growth. This percentage is mid cap growth, and so on. So that'll kind of show you, how concentrated you are into maybe these companies that are large and growth, which would mean for the listeners, a growth company means it's trading at very high PE ratios relative to the average price to earnings. So that means it's very expensive when we're looking at how much money in net income profits that the company is making.
Totally makes sense. I want to actually open up a couple of threads that you pulled open there. And you mentioned one of them, Netflix, not even being in the S&P 500 25 plus years ago because it was being built out of a garage. I don't know if that gives me reassurance or concern. What happens if one of these seven that does have a substantial weight in my portfolio, let's just take Microsoft, for example, here, probably 5-ish% of my whole portfolio is with Microsoft. Yeah. How fast can a company like this fall? Like, does 5% feel like too much for one individual company, knowing these top 10, 20, 500 are routinely changing decade to decade?
Companies can fall very, very quickly, right? Individual companies. Certainly, when you look at, like, I'll say Tesla, Elon Musk, as a little bit of a volatile individual, he goes on his platform, which he also owns, right? X, and he tweets something and the prices of the stocks go crazy. So these things can happen really quickly, but that is why we index. That is why we are diversified. So it's precisely why, we're not picking just Microsoft and we're not picking just Tesla. So, even in your scenario, Microsoft is 5% of your portfolio, right? If that goes down 50%, your portfolio is in effect down 2.5%, which could happen on any given trading day, that alone. So it's like, that is precisely why we index. Now that comes down to your concentration and risk tolerance. Are you okay with how volatile some of these large cap growth companies can be at times? So that goes back to, hey, maybe if you're not okay, that sounds kind of crazy. 5% Microsoft, there's different funds and ETFs out there that might be a little bit more diversified across the spectrum of US stocks that might only have 2% Microsoft in it or 2.5%, right? So Justin's total stock market index that he has is going to own less Microsoft than VOO or, whatever that S&P 500 index is.
I think that makes sense. And you also mentioned that this kind of concentration isn't necessarily new. I don't know if you just meant that from the sense of there are always big companies that are owning a lot of the market, or truly like, looking at my total stock market index, the top 10 making up 30% of that index, the number 30% for 10 companies is not something that is relatively new. Is that the differentiation you were making there, or the point that you were trying to make?
Correct. I think they're both of those are true. Just looking at some market data, there's been actually times in the 1950s and 60s where concentration in the top 1, 5, and 10 was greater than it was today in the profits of those companies. So from both perspectives of just the qualitative, these large companies dominate, but also the numbers, the quantitative. This is nothing new. It will always be. We will never have a stock market that has 500 companies that are all the same market cap, and that's capitalism. Somebody's got to win. But because these, NVIDIA, I'll use that as an example. Unbelievable returns, right? In the last couple of years. Guess what all these companies are doing now? Going after NVIDIA.
Yeah.
So like the market, I'm just a really big believer in efficient markets and markets taking care of things. So that's that from that perspective, I don't really see it as a major issue to be worried about.
I'm kind of with you. I do think capitalism takes care of most of this issue because there might be a company that is leading the charge or growing a space, creating a bigger pie. You think what Apple did with iPhone in the cell phone industry, and now they still own so much of it, but there are other people in this space that are also looking to take some of that market share. And through indexing and diversifying, you might get your loser over at Apple, but you might also get your winner somewhere else down in your portfolio too.
Yep.
So Samsung and Apple might be switching some, taking or losing some of the market share, but you're essentially winning or staying average because you own them both.
Yep, you nailed it. Yeah, exactly. And it's like, we'll get to, I think, some tactical stuff for investors at towards the end. But I think if you're sitting here worried about Apple going down, Microsoft going up, and I think you're probably in the weeds too much on your indexing and just your investing in general. We need to be, it's funny, I do this for a living. So people ask me, even prospects, they'll say, oh yeah, what kind of returns do you give your clients? And it's like clients will ask about returns or something. And I'm like, you know what? As much as it might hurt to hear this, the 6 months, we're talking about is about 5% of the duration we need to measure real returns, right? We need to talk decades if we're talking returns. That's the only period that matters for a true long-term disciplined investor. So, all that to say, consistent disciplined investment over really long periods of time is all you should be concerned about.
Yeah, I think we've probably beaten that drum here on the podcast, but it's always a really good reminder. You brought up the S&P 500 a couple of times now, and I talked more about my kind of total US stock market index. Do you feel like there should be some concern or changes if you're truly only investing in the S&P 500 versus kind of a total US index fund, and actually even bring in international exposure? Or does the S&P 500 cover enough of the US stock market and maybe even have enough international exposure to make the claim that if you wanted to be a single index fund holder, the S&P 500 is plenty?
Yes and yes. So I
know I'm giving you all of these nuanced questions, but I'm glad you're taking it.
I think at the end of the day, if somebody sticks with the S&P for the next 70 years, they're going to be just fine. Me personally, how I believe and how I invest, I'd rather probably tilt in the US a little bit away from all those large cap growth stocks into more of a total market approach, as well as add international exposure. When you look back to the 2000s, that was like the early 2000s. That was the lost decade for US stocks. International stocks were kicking off 9-10% a year or something like that return. So if you see international versus a US stock, if you look at a chart of the relative performance, it just goes zigzag. It goes up, down, up, down. It's just these trades back and forth, right? And we're in a huge period of outperformance for the US the last 15 years or so. So history kind of repeats itself. At some point, international stocks are going to outperform, certainly to take part of that upside, as well as be diversified. If US stocks are going down, I think investors are going to have a tough time just sitting and holding that S&P 500 index. I think it helps with that too. But when you look at a global perspective as well, if we're going to be true indexers and say, hey, we want to invest in the world growing, like I'm an optimist. I really like that proposition. The US stock market makes up about 60 or so percent of the global market cap. So if we're 100% US, we are really overweight US, which is called home country bias. And actually investors in every single country fall prey to this. US investors are just lucky enough to have their country own most of the market. But if we look at equity holders in Australia or other countries, they own like 80% of their stocks in their home country, even though their country makes up like 2% of the global market. It's a problem in every country. Certainly, I think a problem that I like to fight with adding some international diversification.
Why do you think the home bias is at play there? Is it mostly just because we're familiar with these companies and we feel more confident investing in companies we've heard of?
I think so. I think that helps. I think walking to the grocery store and seeing Johnson & Johnson makes the lotion. So I know that company. They're doing well, right? Walmart, they're everywhere. So I think there's that. I think also in an election year and in crazy political times, I think there's a lot of rhetoric out there that is anti-international just in general. There's quite a movement right now of a lot of people just being very pro-US and kind of afraid of a lot of the things. There's obviously some terrible things going on worldwide. So I think some people are afraid of that and thinking hey, if I invest in international funds, I'm, supporting some of these countries and, I don't want to own any stocks in countries where there's dictators or there's coups. So I think that's another thing that pushes people a little bit towards just owning only US stocks. So for better or for worse, again, I think you'd be okay just owning US stocks and saying forget it about international. The historical data would show you'll probably have better risk-adjusted returns with a globally diversified portfolio.
So you brought up this point that the US stock market has been outperforming the international markets for a little while now, and that at some point in time, as history unfolds, that will probably even back out. Maybe international comes back on top. So with that line of thinking, would it be prudent right now to pull back from investing in the US stock market and actually start investing more into the international markets, assuming we're kind of at an all-time high with US markets right now?
Yeah, I will caveat this. I don't believe in market timing at all. Saying that we're at all-time highs and now is a good time to diversify into international could be we could go up. Who knows what's going to happen this fall at the election? It could go either way. Let's say it goes either way. Either way could make it go up another 20%. I don't know. So to say now is a good time to diversify, I would hesitate. I would say now is a good time to diversify only if you truly believe in international diversification for a really, really long time, as I do. If you're just stumbling upon this information, I would say then yes, now is a great time to act. You're just lucky enough to have ridden, a US bull market for the last 15 years. International stocks are very undervalued. So from that perspective, yeah, now would be a great time. But you do have to believe in it long term, right? If you diversify right now, and again, like I said, markets go up, US markets go crazy 25, 30% the rest of the year, you're going to be kicking yourself. You won't if you truly believe in what you're doing for decades. Again, like I'm going to beat a dead horse, but you truly have to believe in the way that you're investing for long periods of time. The less you can look at your portfolio and your balance and your investments, the better off you'll be.
I'm pigeonholing you, and you're doing a good job escaping it, because I love the fact that you're really just calling out, yes, if you believe in diversifying through international exposure, then that is a great idea.
Do it.
If you are truly just trying to time the market or beat the market over the next year, then all you're essentially doing is gambling, because neither one of us, nobody here listening knows, is this got to be the year that the US underperforms the international markets, or are we just got to keep riding the wave that we're currently on? And once again, nobody knows. So the only approach that you can really take is, what do you value, or what would you like your approach to be from a long-term standpoint? And it was really timely that you put out a newsletter today talking about investing at all-time highs. So I kind of wanted to pull a little bit of that information here, because I wanted to double down on some of this, because I am getting a lot of these questions recently, because we're having a great year again, and there's been a ton of news, a ton of headlines in the news about we hit a new all-time high with the NASDAQ or the Dow or the S&P, and people are now starting to question, well, do I need to stop investing? Do I need to stop putting my money here, and should I be thinking about putting it somewhere else that might be safer in the long run? And you just like spit a ton of facts out here. Like one of my favorites is, I can't remember, I got this from your newsletter or another article that I wrote, was that 6.7% of trading days hit an all-time high. So like 6 to 7% of every day is actually going to be an all-time high. And then you talked in your newsletter today too, that there's been 39 market declines of 10% or more, including 11 bear markets. Yet, despite those 39, we've had over 1,250 new all-time highs over that same course of time. So it's almost like this, like, yeah, you're hearing it, and, all-time highs might be scary, but they're also like kind of routine too.
They're extremely routine. Gosh, there's stretches of time, I don't know the stats off my head, but there have been stretches of time recently, I can remember like 70 or 80 new all-time highs between bear markets. When Trump got elected in 2016, that ride-up, this recent ride-up from COVID, I mean, we're talking all-time highs several times a month, really, on average. So it's like, and when you think about it, it makes sense, right? If the market doesn't go straight up every single day, but over really long periods of time, it goes up like 10% a year, it has to make new all-time highs all the time. So it's, some more data, it's a graphic from Dimensional Fund Advisors, a mutual fund company. They had some data that showed basically the 1, 5, and 10-year returns if you invested over the last 100 years at any time or only at all-time highs. And the returns were almost exactly the same. You would have thought like, oh no, all-time highs, like stocks are overvalued. That would be a bad time to invest. No, that's wrong. The best time to invest is now. And I guess this comes up a lot in my line of work. When people have cash for whatever reason, they sell a house, inheritance, things happen. We have a good chunk of 40, 50, 100 grand. Should I put this in the market? I feel like it's expensive right now. Or should we wait? And my answer is always, every single time, the best thing to do is to put it in today. If you have to chunk it in over the next 12 months, like monthly, cool, we can do that. But just know that this is a behavior avoidance mitigation tactic that we're taking. And the best thing to do mathematically for you would be to put it in today.
Yeah, we'll put a bow on this conversation with this Peter Lynch quote that you had in your newsletter too, that far more money has been lost by investors in preparing for corrections or anticipating corrections than has been lost in the corrections themselves. So just come on, you know the psychology aspect of it, you know the mathematical aspect of it. It makes sense to continue investing and stay the course.
Nailed it. Yep.
Erik, let's round out this conversation and move to one more thread here, which is all about super saving. And I was listening to one of your podcasts on Bluff Finance, and this one really rang true to me because we do have a lot of FIRE people in this conversation or listening to this conversation right now. Some in Coast-Fi, some maybe already have hit financial independence, yet they're still doubling down and investing and heavily saving. Can you make some arguments for times when super saving just really doesn't make sense anymore? Are there some moments or some situations where that just might be something you want to reconsider?
Yeah, absolutely. I can make a great argument for that. And I would say in the FI community and the Coast-Fi community and like all these online communities, I would say the biggest component that's missing that we bring from the financial planning world is the life planning component. Like forget all the money stuff. Like, what do you actually want to do? What are we actually saving for? What's the money for? Is this for us to travel to Europe once a month? Or is this for the kids? Like, what is this for? And what does that require? What are those quantitative requirements? That's going to be for our retirement or our Coast FI. And then work back from there. I think people they're psychologically wired, right? These high income earners, they max out their 401k every year in their Roth IRA. They do it year after year after year, and then they don't understand how to actually spend the money, when it gets to those retirement times. So I think there is a huge risk in over saving. Far more retirees, I believe, the data shows far more retirees actually die with too much than run out of money. Most retirees, once they retire, they're taking Social Security, they have a portfolio. On average, that portfolio is not going down to zero, not even close. I think there's a huge risk in oversaving and not living enough is a good way to put it. A great book for this is Die with Zero. Came out about a year ago, but I've probably read it 4 times. It really changes, I think, the way that you'll think about the optimal use of your money. Just kind of talks, just to give a quick summary, just talks about your not only living today and not saving all your money for tomorrow, but also integrating like your health span. You can think about a lot of people listening to this are in their 20s and 30s. Those are years where you're really healthy, knock on wood, hopefully, and we can travel and do some things that you're not going to be able to do when you're 65, 70, when you have all the money in the world. It's balancing all of those things to get kind of this optimal spend throughout your life and not kind of die with a bunch of regrets.
That's actually like really hard to do too, because I definitely fall in the camp of super saver, and I'm coming into a period in my life where I'm trying to pull out of that a little bit because Die with Zero has come up a dozen times now on the podcast over the last 20 or 30 episodes.
Oh, yeah.
I think it's because it's something that I'm really being called to right now and something that's really challenging me right now in this period of my life. And I hear someone like you on the other side of the mic that says, hey, 20s and 30s, some of your most healthy decades, some of your most active decades. Like, what could you do right now that you were planning to do kind of in retirement years? Would it make sense to maybe pull that forward and do that now? And then, if that's taking 1 year off and traveling the world, maybe you just work 1 extra year then, or 2 extra years, however many years you need to work in order to take this year-long sabbatical. It's a really interesting thought process, but I think it's a really hard thing to do for people that have been on the grind and in super saver mode for so long. Because we also hear the flip side. Like, I see the stats on like how many people live paycheck to paycheck, how many people hit retirement age with very little in their 401k balance. Like, there are as much arguments as you can make on one side about people spending or having way too much money when they die. There are also many of stories that we've heard of people that don't have anything, that can't take care of themselves whenever push comes to shove. How do we split the difference and find that perfect trajectory right in the middle. I think it's a really hard thing to do.
It's super hard. And honestly, it's so behavioral and it compounds over time. Like in my line of work, honestly, I see it one of two ways, and you just hit the nail on the head. Is I see people that have super saved and they're still super saving and they have way more than they need and always will have way more than they need. And I'm like trying to tell them to spend the money. And then I have people walk through my door. I mean, I've talked to prospects before that are, they're in their 60s and they really don't have they almost don't have anything to show for it. And it's like I almost see one or the other. Mm-hmm. It's kind of crazy. When those same behaviors do replicate over decades, you can see everyone starts out in the same spot if they all graduate from college, whatever, they're 22. People that are on one track go like this, and people that are on the other track go the other direction. You said it so well, like landing somewhere in the middle. We don't want to die. We don't want a phrase I like is we don't want to be the richest man in the graveyard, the richest man or woman like that. There's no awards for that, but we also don't want to be eating cat food in retirement, right? So let's land somewhere between that. And I think really thinking the die with zero concept, like it's not only money, but the health component is so important. Like everyone's health is going to decline. It's going to happen to everyone. So how do you integrate that and pulling things forward? You said it really well. They talk about that in the book. Like if you made a map of all the things you want to do in your life, a bucket list, if you will, what are those things that like, hiking Everest, like let's pull that forward to our 30s. That's going to be really hard when we're 50 or 60, right? So, I can tell you for us personally, my wife and I are leaving in 2 weeks. We're going to the Paris Olympics for like 11 days to watch all the events. And that was something like, we thought, this would be really fun, like before kids and when we can walk around Paris and we're 30, this is a totally different trip when we're 50 or 60. So that was something we like prioritized, pulled forward, like spent the money gladly.
Man, you read my mind because I was going to ask about your own personal experience. And I know you personally, and you're a good friend of mine too. And it's been really inspiring to see you make that shift as you've become more comfortable. Your business has become more sustainable for you. Like you're really inspiring. We were talking before, Mike, too, of just like, I don't work on the weekends. Like I don't think through that. Like I make this money and I spend that money. Like not only are you going to the Olympics, but you've told me about a lot of really cool trips that you've taken over the last 6 months and a lot of cool things that you also have planned in the future between making a move and a lot of things that for me, that could maybe make me a little anxious to an extent, but almost watching you as someone that's forging the path is super inspiring and helps me feel a little bit more confident. And Justin, like you got to let go of the reins a little bit and you got to say yes to these things that you really want to say yes to.
You do. And at the end of the day, you can always make more money. You know what I mean? Like I'm not saying spend everything you have in your bank account. Obviously, we're going to save, invest, your financial plan's got to be on track, all that boring stuff. But like, we can always go make more money. If we have a growth mindset, if you're reading, if you're gaining skills, you're growing a business, like your earning potential is just going to continue to go up. Money's not really meant to be stored up and never used. It's meant to be used for a purpose. And you can always, if you need to, just go make more of it. So I would encourage listeners to just have a little bit of a lighter view and like hold on money. Like, hey, if we got to spend 10 grand on a trip, that's okay. Like, we'll be fine if we need to make 10 grand more. If you're lucky enough to own a business, like just go work and make 10 grand more, right? Like, and it might not be that easy for some folks, but I would just encourage folks to think a little bit lighter about money.
Yeah, of course, some of this is coming from not a place of privilege, but a place of security. But I was just talking to a listener this week too, and we were chatting and we were talking about this exact same concept. And we both kind of hit this like really, early point in Coast Fi. And it was fun talking to her, similar to this conversation right now as well. She was like, you know what, Justin, like I'm like in my late 20s right now. And yes, mathematically, like if I use the models and I put this all out in place and I put my spending in and where I'm at and the expected returns and everything, like, yeah, I'm going to probably not be able to sustain my entire rest of my life with the money that I have saved right now. But I have a long runway. Like we were talking like 10 to 20 year runway right now, assuming there's no bad sequence of returns that are coming up here in the really near future. But she's like, I also don't see myself putting up zeros every year either in the income category. Like even if I am quote fi, like I'm going to go speak places or I might just want to be a bartender because it sounds fun or my friend calls me and needs help with their startup. So I go work for them for a little bit. Like I'm going to run into money probably on accident over the course of the next couple of decades. And I have this huge pile of money right now to sustain myself through a lot of that current journey.
This is especially true now in 2024 in the world of people can set up businesses, from their house, run them virtually. We can run them while we're traveling. It's just never been easier, in a better spot with all the technology we have to run a business or have a side gig. I just think that I love that mindset. Like, hey, we'll just go make some more money. And like, I thought about this when I was starting my business. So if anybody's thinking about starting one, went to the Air Force Academy, got an economics degree there and got an MBA in finance. So like when I started my business, I was like, what's the worst that happens if this fails? I just go get a 6-figure job. Like, and again, that's coming from a place of privilege, but like again, what's the worst that happens? We just, this business venture fails and we just have to pick up a real big boy job and then start another venture on the side. Like, it's just like, run that through when you're thinking about these scenarios, it's called fear setting. I think that was Jocko Willink. I forget, or maybe it was Tim Ferriss, but somebody talks about that fear setting. What is the worst thing? Take your brain there. What's the worst thing that could happen? Okay. What will we really do then? Oh, we just go get a job. Okay, well, that's not that bad.
Yeah, and we forget. I mean, we're speaking to 20, 30 somethings on this podcast, but it wasn't that long ago that you had no skills, no degree, no job. Like if you just zoom back to 19-year-old you and realize how much progress you've made from then until now, you never get to lose the skill sets and experience that you currently just had. So you're already going to be further down in that journey. If we're talking about 10-year journey for you right now, cut that in half, like probably would only take you 5 years to get back to exactly where you're at right now in terms of income and your savings and investment accounts and all of that. Like it's not that bad. And when you zoom out and kind of look at worst case scenario, and let's be honest, more times than not, it plays out in the positive favor as well.
2 things here. One would be a good book recommendation for what you just said. It's called The Gap and the Gain by Dan Sullivan. And it's really for business owners, but it applies to everyone. And the premise is most people are focused on the gap, which is where they are now versus where they want to be. So I'm making 100 grand. I really want to make 120 or whatever that is. Where people really need to focus on is, hey, what's the gain? Where have we come the last 12, 18, 24 months, the last 5 years? Like, oh my gosh, we were in our college dorm room like back then. Look at us now, right? Like thinking about that and then like that giving you confidence going forward in the future.
Yeah, I've heard the gap gain pop up a couple of times. I've read the book. It's been a while since I picked it up, but I remember it being super impactful whenever I did pick it up. And I think it's a really good exercise. Like me even just being transparent. Like it was not that long ago when I was working at a company making $40,000 and now I'm making 6 figures plus through 3 different ventures. Like that's really freaking cool and exciting. But that gain came in like a 5-year time span. Like your life can look completely different in another 5 years. Like there are, yes, lots of things that you want to do, but I promise you, like if you're working, if you're out there hustling, like if you're doing all the right things, like more times than not, a lot of good stuff has got to continue to come your way.
Yeah, I would add to this conversation too. Another thing to help is knowing what's enough. So I think as your income goes up, especially if you're a business owner, but certainly for anyone that has income that goes up, if we let expenses and lifestyle inflate just as much as our income, we're kind of always going to be chasing our tail. We'll never catch ourselves. But if we do truly have somewhat of a lifestyle that is locked in, we eat out a couple times a week and we buy these groceries, like there's only so many people in the house that have to eat, right? We own this house. Like if expenses are going to be relatively fixed at one point, if income can continue to go up, then you do have that flexibility and that comfort knowing, hey, like we're way above our enough. Maybe we don't have to work so hard. We can take some risks. So that's kind of like another thing I think from a financial planning, life planning perspective, getting to that, hey, what's enough for us? What's enough income, enough money? Because if we just keep working and working and working and growing our income and growing our lifestyle, I've seen it. I've seen the folks that it's crazy that make, no kidding, like $30,000, $40,000 a year, but they have $500K in their 401k because they've just plugged away. Conversely, I've seen folks that make $500,000 or more a year and don't have much to show for it because they're spending it all. It's crazy over, again, really long periods of time, the 2 ways in which people typically go.
Yeah, and it's been fun chasing fire for me to an extent and finally getting to this period where I can start backing off being such an aggressive super saver, but then allowing myself, whenever that money is coming kind of back in, to make a decision on what I want to do with that money. Do I want to like stop working so much and not make as much income because I just truly don't need it? Do I want to buy back some of my time by purchasing services that would really benefit me? Do I want to go buy some of the things that I've been delaying buying, like, and knowing there might be a little bit of lifestyle creep that comes with that, but my younger self promised me at a certain point in time, like I would be able to make that decision at some point too, whenever I hit some of these. And it can be a tricky conversation and balance to have with yourself, but like, it's just nice that you get options in that kind of mentality. And once again, a big reason why I like financial independence, because everybody will have different values around that, but it gives people multiple options on how they want to approach this kind of deacceleration moment that's happening.
Yeah, I think you put it well. I really like what you said. I was going to make the point about buying time, or think about money in terms of time. It's not really natural to think that way. Like, hey, if I put away another $5,000 this month, that might be 2 months of retirement income. That's interesting to think about. Or like, hey, if I don't work this month, or if I make $5,000 less this year, whatever, how many months of that, or how many weeks of that is living expenses? So start think about money, especially in those fire years, in terms of time, is a really interesting use case, because we only have, again, we can make as much money as we want in the world, but we only have so much time. So the more we can have time to do things we love with people we love, in my book, that's really what I'm shooting for. I love saying, like, I want to compete. I don't want to compete with people with money. Like, there's always going to be somebody who has a better business, advisors that have way more clients than me, way more money, whatever, assets, all that. But if I can really make my metrics of success be like, ooh, how much time can I spend with my wife? How many times can I see my parents, my in-laws? How much time can I spend reading a book on the back porch, which is literally like my favorite thing in the world to do? Who's going to be like, oh yeah, you're a failure. Like, my business is way better than yours. Like, you literally can't say that to me if I'm doing the things I love that you can't compete with me at.
I know. It's really about defining those goals or those ROI metrics in your terms. I think is super, super important. My girlfriend, she's a freelance photographer, and we were talking about time blocking before this, and kind of how certain days you're really trying to focus on certain things, and that kind of helps you kind of get in the zone for that period of time. I really like her approach, because she likes to have periods of making money and then periods of just enjoying life or spending money. And like I said, a lot of W-2 employees don't have this luxury, because you can't tell your employer, I want to be working for 6 weeks and then I want to be off for 6 weeks. But her, as a freelance business owner too, she'll pick up a job, go on tour, be on a grind for 6 weeks. And then she has a month or two that is total white space for her. And she creates so much fun and excitement and enjoyment out of it. And it seems like a really good balance for her, because she kind of likes to be all in on something if she's in on it. She doesn't really love the same routine every single day. We complement each other in that regard, because I think I'm probably somebody that would love to just have part-time work all the time and kind of part-time fun to supplement that. I'm not really one that wants to be all in on either or, because I get bored on either direction. But it is kind of cool that she does that, and it really works well for her lifestyle.
Yeah, I like that a lot. I love that idea, especially, I mean, again, we're talking about people that own businesses have the ability to do this. You know, if you have a W-2 job, maybe they might give you Fridays off in the summers. I've heard of jobs doing that before, but seasonality throughout your year and work, I mean, that's another Cal Newport staple. I don't believe we're really meant to work 40 hours a week all year. You know, when our kids, I don't have kids yet, kids are off in the summer. So typically, you know, at least in my line of work, clients don't really want to talk to us. Advisors also don't really want to deal with their clients. So typically summer is really, really quiet, which is awesome. We get, you know, we don't have to sit at the computer as much. We can work on projects. Typically holidays, right? After Thanksgiving, pretty much through the new year, you can forget about it. So I think seasonality is a really healthy thing, because us as humans really aren't wired to work at the same speed, given all the things that are going on around us. We just had July 4th. Typically, people aren't really working much that week. I do love that in the business owner mindset, though, of like, hey, I'll just work. I'll go, and then I can go to like Europe for a month. And then if I need some more money, I just work some more. Like, it's so great. And it goes back to that first point we made about the retirement and fire. Take money. Your money mindset can just be a little bit lighter. If I need more money, I'll just figure out how to go make some more. It's okay.
I really appreciate the conversation. I'm not blowing smoke up you whenever I say you've been a big inspiration for a lifestyle that I'm hoping to emulate here in the near term future. So I appreciate that. Really appreciate the awesome conversation. You mentioned you do have a firm out there and you support people. I'd love to hear a little bit about that. Who's the right person for you? And then you also speak on the side of the mic too, and you have a podcast as well. So can you share a little bit about your firm and where people can stay connected with you in podcast world?
Yeah, for sure. No, thanks for having me. These conversations are so fun. I can't believe we've been talking for this long already. I'm looking at the clock. I'm like, oh my gosh, just flies by when you're talking about interesting stuff like this. I run a virtual fee-only financial planning practice, Baskin Financial Planning. It's baskinfp.com. I serve the military veteran community as well as business owners is kind of my niche. I serve a lot of high income 20, 30s, and 40 somethings is probably like my overarching description of who I typically work with. I talk to pretty much anyone on a 30-minute call. If you think services might be a fit, I would love to learn about you, give you some pointers and point you in the right direction, or talk deeper about services or if it's a fit. I do also have a podcast, the Bluff Finance Podcast. You can find it on any player or the website. Justin and his team do an outstanding job taking care of the production of that podcast. So thanks so much for having me. This has been a super, super fun conversation.
Erik, let's round it out. One final question for you. If you had the opportunity to teach a 16-week class to a group of graduating college seniors on a topic that isn't normally covered in the classroom, what would you teach and how would you teach it?
Oh, man. I would have to say personal finance or really budgeting. I don't think those specifically, maybe they are. I certainly didn't have a personal finance class. I had an investments class. I think if you're in a major of one of those types, you might have a little bit more in depth, but really just personal finance 101 and things you actually need to know, like very specific. That's how I would teach it. I would be very specific with my case studies of like, hey, in the next 5 years, you're going to buy a home. Here's how to work with a realtor. Here's how to shop lenders. I just bought a home in Colorado Springs, or we got under contract. So I'm shopping all these lenders. Like how do you actually do that? Like we need 20 somethings to know these things coming into the world. What's car insurance? What's what's home insurance? Estate planning? Like they should know the basics of these, but in a practical, actionable manner so that when they get out of college, they're not, getting preyed on by those who are trying to sell them maybe a product or maybe whatever is out there. There's a lot of garbage out there right now. That would be it for me. It's just personal finance and just money management, because I see so many 20-somethings just really miss the ball on that early in life.
I appreciate that course. You stay in your lane, but it's important. And everybody listening to this feels like that should be a staple in the classroom, not just in college, but probably all the way through education. Once again, this is Erik Baskin, owner of Baskin Financial Planning and host of the Bluff Finance Podcast. Erik, man, it's been a blast. Thanks for spending so much time with me.
Yeah, thanks for having me, Justin. Would love to do it again. Thanks.
Thanks for listening to the episode. As always, I appreciate your kind words. If you want to leave us a rating and review on your podcast player right now, that would absolutely make my day. If you want to find episode show notes, our blog, and other great resources, head over to tsirpodcast.com. If you have follow-up questions, an idea for a future episode, or just want to say hi, we have a contact form on our website, and those messages go straight into my inbox, and I promise you, I will reply. But all right, guys, I really appreciate you tuning in. I love you all, and you're not alone. Let's keep making it through our struggles together.